It's a great pleasure to welcome you all to our second open meeting this year, where we celebrate the 20th anniversary of the Financial Supervisory Authority of Iceland. Our next seminar in this series will be on April the 2nd, where we shift our attention to the pension funds and the challenges ahead and their role in the financial system in the future. However, we're here today to discuss another important topic: capital adequacy and resilience of banks. A fundamental part of bank regulation is to define the amount of capital that a bank should be required to have and the composition and quality of that equity. This morning, we ask whether the capital requirements on banks we have implemented are sufficient or adequate and suit their purpose or not, whether they're more than enough or maybe not enough. To tackle these issues, we have some excellent speakers with us today. First, our distinguished guest this morning, Professor Martin Helwig, will give his keynote speech. Following him, we welcome Perla Ösp Ásgeirsdóttir, Chief Risk Officer of Landsbankinn, and thirdly, Jón Þór Sturluson, Deputy Director General of Financial Services Authority, will give his speech. Finally, we should have enough time for questions and discussions, but we aim to close the meeting no later than 10 o'clock. Without further hesitation, I suggest we move I'm sorry about this, to our first speaker, Professor Martin Helwig, Director Emeritus at the Planck Institute for Research and Collective Goods and a Professor of Economics at the University of Bonn. He graduated with a PhD in economics from MIT in 1973. During his academic career, he has held academic positions in Stanford, Princeton, Bonn, Basel, Harvard, and Mannheim, and the economics of financial markets and financial institutions has always figured highly on his research agenda. His well-known book, written with Anat Admati, The Banker's New Clothes, What's Wrong with Banking and What to Do About It, was published by Princeton University Press in 2013. Professor Helwig, welcome, and the floor is yours.
Thank you very much for the invitation, and thank you very much for the kind introduction. I will put the question into a slightly wider perspective, namely what has happened since the crisis. What's the framework in which we are having this discussion? Now, I'm often asked, has the financial system become safer? And my response is safer, yes, but that's not the same as safe. And it's not even the same as safe enough. And the metaphor I give for this is a truck that explodes in a tunnel at 150 kilometers per hour. So then we have a discussion about lowering the speed limit. And of course, lowering the speed limit to 80 kilometers per hour would raise transportation costs and harm economic growth. And therefore, we only lower it to 140 kilometers per hour. But since we need to show some activism, we also impose a limit on gas consumption of SUVs. Never mind that gas consumption of SUVs has nothing to do with what happened in the tunnel. It's something that's always been on our agenda. What have we had by way of reforms? Basel III, agreed in 2010, and since then implemented, in my view, has not really marked as dramatic a departure from Basel II as the participants have claimed. There has been no reform of the model-based approach to risk weighting, and the backstops that have been introduced to eliminate some of the most extreme abuses of risk weighting are quite weak. There have been changes in the quality of equity, but much of the discussion can still be led under the heading of anything but equity. For resolution, we are thinking about total loss absorbing capacity, TLAC. Loss absorption is the primary function of equity. So why something else with the same label? Of course, anything but equity. We had this discussion before under the auspices of Basel I and Basel II. And it's interesting to see that most of the Tier 1 and Tier 2 equity lookalikes, or seeming lookalikes, did not perform well in the crisis. The ratio was tripled, but if you triple something close to zero, to quote the Financial Times, you still don't get very much. The leverage ratio of 3% of total assets under Basel III, that's what Lehman had in the last balance sheet before they went bust. Macroprudential regulation, as I see it so far, is mainly a label. We don't really know what we're doing there. If you look at the list of measures that different supervisors have introduced under the auspices, it's extraordinarily diverse. And there is no underlying conceptual framework. We then have regulation on liquidity, but the regulation since then has been very much diluted. Anything but cash, of course cash is always liquid, is the label under which this discussion has gone on. But then, now comes the gasoline consumption for SUVs. We have lots of new organizations. We have new rules for hedge funds. We have prohibitions on short sales. We had an enormous discussion about the financial transaction tax and enormous discussions about structure. In all those cases, it isn't clear what they had to do with the crisis. By now, we see a backlash. The controversy about the so-called Basel IV attempts to fill gaps in the existing framework was an example. American developments with changes in equity requirements, changes in the Volcker rule, and changes in the resolution regime are also examples. So why do we have these problems? Most countries did not have investigations about the crisis. Iceland is an exception there. And there is a lack of a conceptual basis for talking about these things. This is due to failures of the media, failures of parliaments, and failures of the public. Of course, it's very comfortable. For example, the European rules for bank resolution do not have one word about provision of liquidity to a bank in a resolution procedure. Why? Think of Deutsche Bank. Providing liquidity to Deutsche Bank on a daily basis might mean a quadruple digit number of billions of euros that have to be provided. That in a framework where even the European Stability Mechanism with something like 670 billion is highly controversial. So you certainly cannot set up a European, it's politically infeasible to set up a European facility to provide liquidity to Deutsche Bank in resolution or to BNP Paribas. But the failure to deal with that problem, to address that problem, while politically convenient in terms of the legislation, also meant that Banco Popular Español, which was hit by a run, had to be dealt with in a shotgun sale to Santander, because there simply was not the liquidity available to maintain them. If we think about what are the underlying issues, one set of issues involves how to deal with banks and difficulties. Of course, the most favored strategy is to just kick the can down the road. But recovery and resolution are healthier. Allowing exit is also important, especially when the problems of the industry come from excess capacity. The second set of problems involves the prevention of difficulties that might affect the rest of the financial system. On the funding side, that's basically an issue of equity. On the asset side, that's basically an issue of liquidity. And then we have had discussions of structure. On recovery and resolution, too big to fail is still with us. The reforms that we've had are, in my view, ineffective. The cross-border problem is unsolved for institutions that are systemic in multiple jurisdictions. The moment you enter, you destroy integrated operations across the different units, as happened with Lehman Brothers, where they had integrated cash managements, and when the UK authorities entered the bank, they found there was no cash because cash had gone to New York at the previous close of business. Think about integrated IT systems. The Financial Stability Board tries to sell us on single point of entry, but that's politically a no-go, because no country wants to leave control over important institutions in its territory in a crunch to the authorities of another country. I mentioned the funding problem. I should also mention that there is nothing about fiscal backstops. The TLAC are, in my view, a make-believe device, and the distinction equity before and TLAC in resolution is a fallacious comparison. The key issue is that if you have the equity, you may not need to go into resolution at all. The discussion about structure was based on a flawed nostalgia. I see absolutely no reason why structure made a difference. And the interesting feature there is that there never was a question, what are really the issues about structure? What should be the issues? One of the things that has gone wrong was investment of surplus funds at, say, the retail level was driven by structures with bad governance. Now, that happened at arm's length between the money market funds and Lehman Brothers. It happened inside a given institution with UBS and UBS Investment Bank, and it happened in the hybrid structures that we have in Germany between the savings banks and the Landesbank. Contagion. Is contagion inside an institutional structure more dangerous, or contagion through markets and through contracts? Resolution. Does complexity impose issues on sort of constraints on the ability to resolve? So those are the questions that should have been discussed in terms of structural reform and weren't. I could go on and say the same things about liquidity, but and about shadow banking, but I want to go to the issue of equity. Equity improves liability and incentives, and it doesn't interfere with the bank's actual business. If we look at developments since 2010, I mentioned before the actual increases since 2010 were not large. Actually, for European banks, you go from equity ratios of 2 to 4% in 2008 to 4 to 7% today, which is roughly what they were in the late 90s. The supervisors had a bad conscience, and since 2010 have done all sorts of things under the auspices of Pillar 2, some of them intervening with what the banks actually do in their business, which I think is harmful. If you have higher equity requirement in the first place, you have better liability and better incentives. Equity also reduces systemic risk. Now, here one needs to address a misunderstanding. This is not just about systemic risk from a bank insolvency. It's also systemic risk from what happens before insolvency. If you think about a bank that has a leverage ratio of 2%, if they make a 1% loss on their assets, that means 50% of their equity is wiped out. That's a huge number. If the equity was 20%, the fraction of equity that would be wiped out by a 1% loss would be much lower. If they react, say, to reestablish the 2% ratio, that means they have to sell half their assets. And that's a huge impact on markets if different banks happen to be in difficulties in the same time. When we think about systemic effects of equity requirements, deleveraging multipliers should be a key focus of attention. Of course, Basel II had reduced regulatory capital quite dramatically, so the 10% core equity meant 2 to 3% of total assets, using internal risk models and their effects on equity ratios were quite detrimental. On internal risk models, I said before over breakfast, the standard reason for why we need this, why we need risk weighting in the first place. Surely you agree that a bank that takes more risks must use more equity to back up what they do. What that really means is that a bank that claims it's taking less risk should be allowed to get away with less equity backing. The part of the story that appears in the rhetoric, namely greater risk-taking should induce more equity requirements, rarely has a match in reality. But there are lots of make-believes about risk-taking that allow reductions. And just think of risk weights on sovereign debt, such as Greek government bonds, 0. Risk weights on interest rate risk in the bank book, 0 until the last round of quote-unquote Basel IV. Risk weights attached to correlations, as in subprime mortgages. All of that was make-believe. And all of it allowed equity to go close to 0. Before the crisis, equity on stuff in the trading book was less than 1%. So there are lots of discussions about these things, and my co-authors and I have argued that much of the stuff that's being said about this is either fallacious or irrelevant, or, this comes from our dear colleagues, mythical. And that there are good reasons to regulate equity because they are market failures. Fallacies, outright nonsense. The British Bankers Association in 2010, implementing Basel III will mean British banks need 700 billion more in equity, and that's 700 billion less in funding for the economy. A simple confusion between equity, which is a funding instrument, and minimum reserves, which is an asset. Irrelevant facts. Well, equity is expensive for the banks, and I quite agree with that. But two major costs come from taxes and implicit too big to fail subsidies. Since debt is exempt from corporate income taxation, that creates a bias in favor of debt and makes equity privately more expensive. Of course, for the finance minister, it's the other way around. So, too big to fail subsidies. Well, if you're deemed to be too big to fail, you can borrow more cheaply. And the empirical literature has shown that about 50% of takeover premia for bank mergers in the US in the 90s that crossed a threshold of 100 billion balance sheet, 50% of the takeover premia can be attributed to the too big to fail premium. So this is not small. I'm not going to bore you with theoretical models that are very strange. Some of them we've actually left out of the book because a banker asked, is this an academic thing? Market failures. What are the incentive effects on bankers, and why do we need regulation? Well, some come from the discrepancy between private costs of equity and social costs of equity. Some come from an additional effect which has to do with the dynamics of bank funding. At any time when the bank has debt outstanding, and that debt is subject to a bankruptcy risk, that in itself creates a bias for further funding decisions. Why? I mean, the standard formulation is, we don't want to issue equity and dilute our shareholders. Well, the mere point of dilution is not the real issue. A smaller percentage in a larger company may still be a good thing. Because if the bank issues new equity, it takes in funds and can do things with these funds. The problem is that from the incumbent shareholder's perspective, the devaluation, or they suffer a loss because some of the benefits from the added assets do not accrue to them, but accrue to debt holders or taxpayers, because the added assets reduce the bankruptcy risk of the institution. So what's the underlying reason for that bias? Well, there is no prior contracting. If it was possible to contract all future funding decisions before the bank even starts, one might put down a commitment. If the bank's hit by losses exceeding so and so much, the bank's going to replace those losses by issuing new equity, and that would have to be a legally binding constraint. In practice, there are many reasons why we don't have that kind of commitment, among them the huge fragmentation of people funding banks. And that actually harms the banks themselves. So the regulation to some extent provides a substitute for the inability of the bank to commit its future, to effectively commit its future funding choices. And at that level, I mean, there we have another stage to this notion that equity regulation provides a mechanism of commitment. So, on these slides, I have a lot of list of bankers' new clothes. Bankers' new clothes is our metaphor for the arguments that we're given, fallacies, irrelevant facts, and myths. But I will discuss, sort of looking at the clock, I will discuss just very few of them. One question that always comes is, where would all this equity come from? Well, take a simple thought experiment. Suppose a bank issues equity and uses the proceeds to buy shares and other securities in the market. So cash goes into the bank and right out of the bank. On net, there is no flow of cash into the bank. All you get is a realignment of securities ownership patterns in the economy, as with a stock fund. That idea is, what you also get is, by the argument I've given before, dilution of the shareholders, of the incumbent shareholders, and an improvement of the position for the debt holders. That procedure actually has the advantage that it can be done quickly. So there's no need to wait for accumulated profits, retentions, to allow a rebuilding of equity, which is problematic at times of zero interest and low bank profitability. Higher equity requirement will raise the funding costs. Okay, I've really discussed that. We cannot have stricter regulation than others, or our banks will suffer in global competition. This must be a proposition that is of keen interest in this country. Suffer in global competition. Well, the German authorities were very lax on supervising banks before 2008. I think they're still lax, but so the supervisor never once asked a question, what are you doing with these special purpose vehicles that hold toxic securities in the US? Of course, at that time they weren't called toxic yet. It was all a matter of making them competitive. That laxness cost German taxpayers something like 70 billion euros. It would have been much better for Germany if the German banks had been much less competitive. And I'm sure that people in Iceland share that view. A key misunderstanding is the global economy is not something like the Olympics. There is no national interest in the competitiveness of our banks, just as there is no national interest in the competitiveness of our male persons. The real question is about use of resources. All those physicists who work as quants in banks have competences that might be used, say, in thinking about batteries for cars, or in thinking about storability of electricity from windmills. Where are they best used? Standard argument in trade theory: if competitiveness is due to the imposition of costs on the rest of the economy, that's a bad idea. If a chemical company pollutes a river, should we admit that? Should we allow German electricity companies to run nuclear power plants just because the French and the Slovaks do? And please, in the name of international competitiveness, do so at the security standard of Bratislava or Fessenheim? With environmental issues, the lobby would never get away with that argument. In banking, somehow it seems different. We need banking regulation to reduce the fallout from risks on the rest of the economy. That's the risk for payment infrastructures, for market-making infrastructures, costs for taxpayers, and costs for the economy. And the key issue about equity requirements is they improve liability and reduce bank vulnerability and the systemic feedback effects that I talked about before. And on that note, I will end.
Thank you, Professor Hedvig, for your intriguing and stimulating intervention. Next, I would like to welcome, I'm so sorry about this, to welcome to the stage Perla Ásgeirsdóttir. She's the Chief Risk Officer of Landsbankinn. There's an ongoing dialogue between us, the regulator, and the commercial banks on the capital requirements that are in place. That dialogue enhances mutual understanding and is an important part of the decision-making process. So we're looking forward to hear what you have to say today, Perla. The floor is yours.
So, I think I will skip to my slides.
Oh, yeah. Sorry.
Okay. I turned technician.
Yeah.
So, nice to see everyone here today. I'm quite amazed of the interest of capital and resilience in banking. I didn't quite expect to see so many of you. For those of you who didn't know me, I transitioned from over to the dark side around 9 years ago, when I left the central bank and investigation committee to join commercial banking. I tend to believe that I'm in the gray area since I'm in risk management, but that remains to be seen. So, just to be clear, these are my opinions. This is not of Landsbankinn. I might go a little bit overboard in transitioning my opinions to you, and I hope they will appeal to everyone. I am the banker in the middle today between regulator and academic, and so I would like to at least point out some interests that the bank have in the current regulatory environment. So Iceland is very slow to protesting. So just to give a little bit of a background, every 50 years we tend to protest. And we did that when we joined NATO, and then we did that when the banking crisis hit upon us. There have been some protests now, but not anything in the liking of 2009. In 2009, I decided to join commercial banking. And being head of risk, I was quite amused or quite scared to see default rates going up to 50% cross defaults. And of course, the magnitude and the task was enormous. We then were playing by the Basel II rules, with the exemption of not being able to use our internal models for risk weight calculation purposes, because we were just not ready yet. So I do tend to agree that increased and more harmonized equity and liquidity requirements were necessary. And that's me coming from the regulator's side. Because there were necessary speed limitations in banking. We were, as you put it, so very nicely, we were driving too fast. There were too much variability in the requirements between countries, and then of course between regulators, and then of course between banks. So now we are seeing more harmonized regulation, but we are also seeing a little bit more variability between the size and scope and nature of the institutions that the regulations apply to, which I think is a very welcome change. Big, globally important financial institutions are more dangerous and less likely to fail because they will be saved rather than the smaller ones. However, what I find lacking coming from a very small financial market is a distinction made between market size, liquidity availability, and structure of the financial markets that the firms work in, operate in. And this, I find this very unharmonized between the current regulations. And this is hampering us a bit. This has, of course, impact on us, for example, liquidity-wise, for example, funding-wise, and just normal operationally-wise. And I put there a couple of points that have been problematic in the Icelandic financial economy, at least for my bank, which are not a problem, for example, in the Scandinavian and Nordic countries, and which is not a problem in Europe. And there, I think, we need also to focus on the dramatic difference between the regulations that are now being put in place for financial institutions and the lack thereof of regulation for non-banks, which are now operating, as you mentioned in some parts of your slides, as the shadow banking system. This can create incentives for our customers and borrowers to go to unregulated markets for their own funding. And what I find, and I think we are in agreement, is that the degrees of freedom between the regulators are quite wide. So we don't always know as banks, and I'm taking a metaphor here, if we are going to do carpentry next year, and then plumbing the year after that, and then the year after that we might do some masonry, because the degrees of freedom are too wide. I find that the study of the effectiveness of both country-specific regulation and the system-wide effect of capital buffers is lacking, and as you all know, the previous banking crisis was based on Basel II reforms, where perhaps we should have studied the long-term effect a little bit better. What I find in the Icelandic economy, and I will refer to that now, is the signal that we get is reduced speed now. We don't always get the transitional phase that the European and perhaps our US counterparts get. And this has several problems for us. For example, just in how we lend to our customers, how we price the products that we are selling to our customers, how our processes are built up, and then how and what we sell. And I think that refers to my comments on the degrees of freedom. There needs to be a harmonization of how much degrees of freedom we can actually use in every country. I do agree that we need some, because every market and every institution and every financial system is different. But we need to have at least some harmonization on how we implement them and why. I know that we might not agree on RWA or REA. I always refer to RWA because I'm old. RWA is something that the Basel Committee put forward. We can use the standard approach or we can use our internal models. And as we discussed over breakfast, my point is, if the regulators don't want internal models or don't trust internal models, they should just ban the internal models. But the mitigating factors that are actually put in place in the regulations should then be something that we as market participants should be able to use with, of course, good discussions with your regulatory authorities. There are several factors, for example, in the Icelandic regulations that are quite unclear and or just missing that we encourage the regulator to either look at or at least then ban if they are not wanted in the Icelandic market. And of course, we have not been able to use our internal models up until now because there is not much enthusiasm by the regulator of us using them. We have been trying, and perhaps we have been trying too hard or trying too quickly, and the experience is such that, as they said, internal models are kind of deceiving for the actual equity that we should hold. But I believe with the Icelandic experience that we are not better off with models, especially not in the downturn. But that's my private view, not of the banks. This has caused us being different. And now I'm not complaining about competition as such. I'm complaining as a consumer in Iceland. Our loans are more expensive because we cannot use similar policies and regulations as our counterparts in Scandinavia. So this is a picture that I conveniently borrowed from a colleague of mine, and you see the Icelandic banks in the red circle. So our equity calculations opposed to risk-weighted calculations, we are just on the other side from other Scandinavian banks. And I think that we are that much of outliers that we need to look at this in a proportional manner for the Icelandic economy as a whole and for our consumers. Now, yes, I do believe that parts of the capital buffers were and are needed. But where, when, and how to place those speed bumps within the banks? I think they can increase resilience within the financial institutions themselves. And I follow the theoretical thinking about them. But how they are implemented, unfortunately, varies greatly between countries. We don't have a good playing field between Pillar 2 and capital buffers here in Iceland, in my opinion. We need to focus on this a little bit more so we don't do the double counting that everybody is so afraid of. And this has, as I showed you in the previous picture, resulted in a higher capital requirement for Icelandic banks in comparison with our Nordic peers. Now, maybe we need it, and maybe we should actually have higher capital than the Nordic banks. I'm not here to answer that question, but we at least need to know why and that there is no double counting in between. And with the limited funding possibilities in the ISK and the Icelandic market, this results in, of course, higher leverage ratios for our banks. And what I do sincerely hope is that the capital buffers don't become a tax, because you always know that the government, they put a tax on you and it never goes away. But this is supposed to be a financial stability operations machinery within the banks. We need to know and need to have a clear view on when the buffers are increased and when they are decreased, and this is supposed to help our financial stability in a system as a whole. Now we are unfortunately, or maybe it's just me, and I refer to all you bankers here in the podium later on, we're a little bit unclear on when they will stop increasing, and maybe they will stay flat, or maybe they will decrease, or maybe we'll just have them as high as we possibly can until the end of time. But it's easier for us as bankers to know where we are going over the next 3 to 5 years. And I think that we need to look at our Pillar 2 requirements with respect to double counting. I think we are actually double counting somewhere. I would like to point out some specifics, but that might reveal a little bit too much about my bank, and I don't want to go there given that there are other bankers in the room. Given all this, I think for all of us, it's our main focus to have a healthy and Icelandic financial system. We don't want to go back to 2008. And it's our job to drive safely within the speed limits. But we don't want to go here. And we are actually going here with BRRD, IFRS 9, all the different sorts of regulations and rules and policies that are supposed to give us comfort when we go to sleep at night. But it's not. So we need to be careful and navigate safely and effectively on the road ahead. Thank you.
So thank you, Perla, for your very interesting insights. I'm looking forward to looking deeper into that. Finally, I would like to welcome Jón Þór Sturluson, Deputy Director General, to take the stage and give us some insight into the perspective of the Icelandic Financial Supervisory Authority. I think it's by time after what you've heard from Perla. Maybe I should now try to do my job on the technical. Here we are.
Thanks. Thank you very much, Sundur, and thank you very much, Martin and Perla, for your contributions. I will try to make this as short as possible so that we have time for discussions earlier. My role here is clearly to be somewhere in the middle of the two previous speeches. We've had a very strong lecture for the need of additional capital and very much a reversed role, trying to argue that we are have much higher capital than Europe, and we are clearly off the wrong track. I presume that Martin is of the opposite view, that it is Europe that is not in the right camp, that we are more correct. But that's not my speech. I'm here just to explain a little bit how we deal with the regulatory environment, and how we interpret it and how we apply it. What I would like to emphasize first is that this is not only about capital. The powers that are invested in the supervisory authority to deal with all kinds of risks in a potential sense are numerous. The first one is just the additional own funds, or the Pillar 2 requirements. We also have the powers, and this is much too small for me to see here, to make all kinds of provisions for arrangement within the bank, and ask the bank to plan for or to make a plan to restore compliance. So these are the three sort of typically used tools in the supervisory area. But the list goes on. There can be a requirement for a specific provisioning policy. There can be limits to certain business operations, whether it is closing down branches or whatever. There can be provisions to reduce specific risky activities. There can be a limit to variable remuneration. There can be limits to the use of net profits for them to increase their own funds, and the list goes on and on. So we're not only talking about capital. That's one reason. It's very important also that everything is not solved with just capital. And it was touched upon a little bit by Martin. It is also the governance issue. It is how the bank is run, that the bank is not only safe in the sense that it can withstand difficulties, but also that it's sound, that it really has a fundamental framework that is robust and is trustworthy. That being said, we are mostly talking about capital here today, and what we are living in is a European framework and that is taking Basel 3, 3.5, Basel 4, or whatever you want to call it. It is to a large extent prescribed by the authorities when it comes to the microprudential side, which is the Pillar 2. It's a lot to do with the European banking authorities' prescriptions in terms of technical standards and guidelines on top of the legislation. And then when it comes to the macroprudential, the guidance comes predominantly from the ESRB. But as has been said, that is a much more open field of study, and countries have applied that in various different ways. Now, I just want to put on the table the situation in Iceland. First of all, when it comes to Pillar 2 requirements. Now, this is the aggregate or the average, if you want, development of Pillar 2 requirements for the 3 large Icelandic banks. And what is obvious is that this is not a static picture. Capital requirements that are looking at individual risks have been going down over the past few years. And the reason, in the view of the supervisory authority, is quite simple, that risks are going down. There is improved asset quality that is explaining why credit risk is going down. There's also changes in the balance sheets of banks, reducing market risk, which is reducing the market risk factor. And there's also a reduction in other risks, which in previous years was mostly legal risk, or risks that had to do with uncertainty, with certain fallout issues from the crisis. These have been reduced enormously, so we have a much smaller capital add-ons now than we did 4 years ago. And this is, from our perspective, the correct measurement, or as close to that as we can get. Now, if we go to the macro side, the picture is quite different. And therein comes the let's say, frustration from the industry that we are compensating or we are double counting. But this is not so much a change in policy. What we have done is we have implemented all the major capital buffers that are prescribed in the CRD. This is the capital conservation buffer of which is actually fixed of 3%. It is the systemic risk buffer. We've applied it to 3%, and I will come in a second to why we think that is appropriate. And then we have been increasing the counter-cyclical buffer steadily. Some may argue why this is still on the rise. Well, the simple fact is that the banking system is still on the rise. Whatever you feel about the economy, this is still the picture that is quite vivid in our minds. There's also, of course, a fundamental difference between these two pictures in the way they are treated by the regulator. The Pillar 2 is part of the minimum requirement. The capital buffers are not a minimum requirement. If a bank ever does not fulfill these requirements, the worst that can happen is that he has to conserve capital. He has to limit payout, whether it is dividends or variable remuneration or whatever. So this is a much softer requirements. But still, you need higher quality capital to fulfill these requirements. I completely reject the hypothesis that there is a widespread double counting of risks between the two categories. And I will just point to one example to the contrary. I urge you to look at the FSA's recent publication of supervisory benchmarks for concentration risk, which is a very large part of the credit risk, where we have very carefully tried to distinguish what is a part of the systemic risk buffer, and only where a bank is diverging from the market as a whole, we are planning to apply or urge the bank to make their own estimates of what their concentration in terms of industry exposures is. So this is an example, but this is the way we approach this. We are carefully, as much as we can, trying to avoid this problem of double counting. It is understandable that you think we haven't done our job well enough, but actually we think we have done it quite decently. At least we are trying as hard as possible. But on the positive side, when it comes to Icelandic banking, I think the reduction, both in the requirements and reduction in actual capital, is warranted. We have seen an improvement in asset quality, which is, of course, the most important metric. I also mentioned that market risk has been going down, and same goes for other risk factors. So the change in the environment is a little bit warranted by changes in the market conditions. So over time, I've seen what has been happening. I would also like, a little bit like Perla did just recently, give you our view of the international comparison. And a very good tool for that, and let me make this advertisement, the EPA, of which we are members, regularly publishes a wide transparency exercise for hundreds of European banks with a lot of different key variables, which makes it very much easier to compare between banks. And the results from last year, which is based on data from the second quarter of 2018, gives us an interesting picture. It tells us that we have more capital in Iceland, as everyone here knows. The most stark difference is that the leverage ratio is much higher here than in Europe. It's about 15%, while the European average seems to be about 5%. We have very decent non-performing loans ratios of 2.5%. It's actually, this is an anomaly. They are a little bit lower now at the end of last year, and so on. The banks are in a way slightly simpler than the average European bank. If you look at the share of net interest income in the total income, so standard banking is more predominant here than on average. And even if we would like to share improvements in the cost to income ratios, these are still pretty average in the European comparison. But it's always very difficult to look at these large comparisons, and we have sometimes been interested in finding how do we compare to similar banks. It's difficult to find similar banks to any single bank, but if we focus on size for a minute and look at these are 14 banks, so there are 11 additional banks that are the closest in size to the Icelandic banks in the sample. We find that there's some differences still. When it comes to asset quality, Icelandic banks are a little bit in the middle. This is a picture giving us two indicators. First of all, the NPL ratio on the horizontal axis, and the coverage ratio of NPLs on the vertical axis. And this is an interesting comparison because it tells us that, well, while the NPLs is not as sort of in the middle, we also are sort of in the middle in how much we have a provision for the bad loans. So this does not give you a reason to be alarmed. If we look at capital ratios seem to be not that far from the average of these, let's say, similarly sized banks. But again, if we take account of the risk weights, the previously mentioned case is obvious. Leverage ratios are much higher in Iceland than in most countries. Risk weights are higher in Iceland than in most countries. And the question there, therefore, is this appropriate? Who are right, we or the rest of Europe? It is not a simple thing. I'd just like to draw out a couple of things that are the key explanatory factors. First of all is the standard approach that is being used here by all the banks, but not the internal models. Secondly, the composition of lending is not necessarily the same as everywhere else, but this can go in both directions, so I wouldn't put too much weight on that. It has been mentioned that Iceland has not incorporated still the SME supporting factor, which is basically a discount in risk weights for small and medium-sized enterprises, which is a kind of problematic in the Icelandic case, since all corporates are small or medium-sized in Iceland. And finally, there has been a very limited Tier 2 funding thus far, meaning that if banks would fully utilize the regulatory framework for that, they might reduce the leverage ratio a little bit. In the leverage ratio, it's only Tier 1 capital that is counted. So the answer to the question would be almost automatically from the regulator's perspective, well, if we take the regulatory framework as correct, then we have chosen the correct capital adequacy. But of course, this relies on the big caveat that the regulatory system is correctly calibrated. And secondly, we have not any prejudices against the models. We have simply said in our communication with banks, if you want to use a model to estimate your risk weights, it has to go through the scrutiny that the regulatory system provides. It has to be a sound and a system that both the bank and the regulator can be confident with. Then it is the macroprudential side. Are we applying macro-pru rules too harshly? And clearly there are differing views on that. But I would just like to raise a few arguments in favor of the current stance. First of all, we live in a country with high volatility economically wide, and also when it comes to default rates. We don't only have to go back 15 years to show that, and Perla has already provided a good example. We also have a small economy, meaning that industry is quite integrated, and concentration in lending is endemic. And this has the effect to exacerbate the fluctuations. It creates a certain correlation in defaults, making the volatility even greater. There's also an issue that we, as a small open economy with an independent monetary policy, very much reliant on resources, have relatively few well-defined common risk factors that are affecting all kinds of industries, not only individual industries. And on top of that, we have 3 systemically important banks, which is very hard to imagine that any individual bank could be resolved without larger consequences for the system as a whole. Now, just as a final slide here, I think if we look ahead, there are a lot of issues to be looked at. One is the internal models issue, whether risk weights are appropriate. We haven't had our final say. I thought Perla was particularly polite when she said that the regulator has not been very enthusiastic about the models. That may be correct. We definitely are not against models. We think there is an interesting trade-off between risk sensitivity, and I definitely believe that is important, but it's also important to look at the quality of the models and of the data that they are calibrated on. And it's also worth looking at, from the bank's perspective, whether the new, let's say, add-on to Basel III is a worthy improvement that makes standard approach more workable. There is more risk. There's more risk sensitivity in the standard approach that is being implemented. But also there's less risk in using models, in that there is now a firm backstop, or the so-called there's a maximum of sort of minimum of risk weights, which equals 72.5% of the standard approach. This also has to have an interplay with the MREL requirements. The BRD implemented rules. We will definitely not have any TLAC issues here, but MREL is an issue here, and then the list goes on and on. There's also very much in the discussion, and this relates to the SME supporting factor, all kinds of issues and interests in making capital requirements responsive to other kind of social agenda items. And of course, supporting small, medium-sized companies is good for many different reasons. So is supporting the environment, and there are ideas floating around to reduce risk weights for green projects, and opening up to such avenues could, of course, end up in a long list of special cases that need support, that grant some rebate from capital requirements. And finally, my final point is, and this is I think what is inevitable, whatever regulations we have and how careful we calibrate them, there will always be an uncertainty of what is the correct capital adequacy. And we need to, also approach this from the perspective of the outsider outside the regulation, and simply regularly ask us our questions: what is safe for the market that we live in? The best known tools for that are stress testing, and it's of course a very positive side product of the new project of merging the central bank and the FME, that we will have better tools, or we will have better opportunities to pool our resources in that department. And I think we need that as a benchmark, or we need that as a comparison tool to the regulations and the careful way we try to implement them. So thank you very much.
So thank you, Jon Thor, for your contribution. And now we have time for questions and comments from the audience. So who wants to start? We have a microphone that will be, a colleague back there, he is ready with a microphone. So I would ask those who want to take give a question to introduce themselves. We have the first one, Governor of the Central Bank, Sigurður Már hérna.
So, is that on? Yes. I was not intending to be first one, but people seem to be hesitating.
Thank you.
So, this is a question mainly to Martin Helvig, because you hinted, rightly so, that we cannot have probably a completely safe financial system, and probably we don't want a completely safe financial system. But you didn't tell us what you think is needed, say on average, and say in Europe, as a minimum equity ratio for a system that is sufficiently safe. And that brings me to another issue, which is partly a question or a comment to Perla. Is it the case that some of the complexity that has been introduced into the system, and we saw in all these travel lights, is there because basically we do not have enough equity in the system? We are trying to mitigate that somehow, and we are trying to hide that somehow, and so there might be a bargain to be struck with the industry that if we were to have a higher leverage ratio, you could have a benefit in less complex and burdensome regulation.
Thank you, Maud. Yeah, please, just to go ahead to answer.
What is needed? Of course, we are quoted and sometimes bad-mouthed for mentioning leverage ratios of 20 to 30% in our book. I don't really like to talk about numbers for the simple reason that the meaning of numbers depends on the framework that you have and on the interpretation you give them. One question is, what's on the balance sheet and what is not? We would like everything to be on the balance sheet. The other question is, what do you do if some ratio is violated? So when we say 20 to 30, does not actually mean any number in that interval is okay, but what it means, and we explained that in some detail, that we really need to think about a graduated system of intervention, beginning with nothing above 30, and then say restrictions on distributions, restrictions on bonuses between 20 and 30, and then more drastic intervention once you go below that. So if one talks about a detailed number, one needs to take all those things into account. Where do our numbers come from? Well, these are the numbers we observed pre-World War I, which was the last time the government wasn't involved. It's also numbers that the banks themselves tend to impose on their own borrowers, even if these are borrowers such as hedge funds in the financial industry. That may be weak justification, but at the same time, having the difference between that and the 3% leverage ratio makes clear that we really need a striking difference. On the complexity, my answer is wholeheartedly yes. And this includes a comment on the two discussions. On the side of SME, green, etc. conditioning, I'm all with Jon Thor. Don't find the political arguments to be really convincing. If we want to subsidize SME lending, for which there are good reasons, it should be done directly rather than by subsidizing bank borrowing. Basically, lower equity requirements means a subsidy to bank borrowing and a distortion of incentives there. I'm bothered about the complexity also in the regulation, and I thought both presentations gave an indication of what I mean. Actually, a few years ago, at a conference at the Nederlandse Bank, I talked about systemic risk and macroprudential policy, including the complexity of how you implement macroprudential rules. For example, under what conditions do you decide to loosen up the countercyclical buffer? And afterwards, a Dutch economist came up to me and said, This is also complicated. Why not just have a high capital ratio and forget about all the rest? And I think there is a certain logic to that, namely, with the high capital ratio, there's a lot of other stuff that you can just forget about. And I think politically, it might actually work in the sense that the industry itself would probably be relieved to be freed of the micromanagement that we currently observe in some circumstances.
Thank you. Padla, would you answer the question? Well, maybe the question is on the complexity due to the insufficient equity.
I think Martin answered that quite nicely. I'm not in a position to, be in any negotiations on behalf of bankers, but I think the cost and ultimately the complexity of all the regulations is something that we need to be very careful about in the near future, because I think, and I actually see areas where they clash, which might be just not beneficial for the economy as a whole. So I tend to agree, but I'm not answering for all banks.
Okay, thank you. Someone else? Yes, Stefan?
Yes, thank you very much. Stefan Peterson, CFO of Arion Bank. I have two questions. Does it work? Okay, it does. One for Jon Thor, one for Perla. Jon Thor, you showed us a list of similarly sized banks as we are. And just out of curiosity, are any of those banks DSIFs? And one to Perla, actually, because you've seen the Financial Stability Board levying additional buffers on the banking sector as of late, taking effect this year. Who will pay for the additional cost? Thank you.
So maybe you just go ahead and answer the first. Jon Thor?
Did I understand you correctly that whether these other banks in the sample were GSIPs?
Were DSIFs, domestic?
Yeah, domestically. Okay, yeah. I don't think so. These are pretty small banks by their national standards, except for the one in Romania. But no, this is I mean, there's one Norwegian, no Swedish, one Danish, Belgian. So no, these are small banks. But that would but they are in many respects on an average at least have similar like interest income ratios. So it's like it's not specialized banks, but it's sort of in many ways similar, but clearly not regionally significant. Can I use the opportunity to respond to the question about simplicity and scale?
I think so, yeah.
Because I might have an interesting argument here. I think if you want to regulate an industry, you have to appreciate its complexity. And I think it's dangerous to assume that broad measures can be safe. I think there are much more opportunities for bankers to do dishonorable or bad things than to run a risk of putting an extra debt on taxpayers. There are all kinds of issues that we are dealing with. So I wouldn't automatically agree with this, and I think that risk insensitive capital requirements can be of risk in themselves. It is. I mean, we have to go back to the adoption of Basel II versus Basel I, where risk sensitivity was strongly introduced. I think this argument still holds that if you have a very crude capital requirements, you have additional incentives to take risks within each risk category, which will ultimately have negative effects on asset quality. So these things have to be balanced out at least. I would love that if banking was very simple, but it's not. And I think therefore regulation has to have a certain level of complexity in it.
So, yeah.
So, again
Yeah.
to you, Stefan. Who will pay for the additional cost of increasing capital buffers? Which is the same, if I refer to previous comments, is who is paying for the lack of trust. And that is in the end consumers, if you want the politically correct answers. It is our customers, and in the end the society, but they will also pay if we have a failure. So yes, we have to be careful.
So there's time for.
Excuse me.
Yeah, I'm sorry. Yes, please.
We started a war here. So.
Yeah.
First, I think it's not necessarily a good idea to meet complexity with complexity, because you can only do that if your own complexity and response is fully adapted to what's happening in the industry. And I don't think that's possible. If I look at the way the complexity has worked, the industry has been able to exploit the downscaling of capital requirements through risk models, even in cases where this was all just a matter of make-believe. We can easily compromise in that I agree that if you want to have risk weights that add to capital requirements, that's fine with me. But I think that if you get into the neighborhood of zero, sovereign debt, think of Dexia or real estate, both of which succumbed from equity ratios on the order of 1%. Then that's very dangerous. On the question of who's bearing the cost, I think if the cost is a social cost, I'm sorry, if there is a distortion in banks' own funding decisions for the three reasons that I gave, then correcting that distortion just means that efficiency is improved. And if the greater cost of bank funding that comes from a reduction in tax effects and a reduction in too big to fail subsidies, if that's passed on into lending rates, that means that bank borrowers just have to bear the true social cost of what they're doing, rather than enjoy a share in the subsidy provided to banks. So before one is raising just the distributional issue, one needs to think about what is the true social cost of borrowing from banks.
Thank you. Yeah. Maybe time for one more? Or I don't see a hand up, and it's almost 10 o'clock, so we will call this a day. I want to thank the speakers again for very interesting interventions, and have a good day.